So this is chapter 7, stocks and their valuation. I do this chapter actually after the chapter on bonds, because in my humble opinion, it is harder to price stocks than bonds. Even though bonds, it appears to be more sort of rigorous. It appears to have much more detail and precision, but it's actually the precision which makes it easy, because it's basically an arithmetical. The valuation is based on simple arithmetics. You'll see what happens with stocks, even though most people equate investing with stocks. And I think by now you know that I try very hard to clear the minds of that misconception. Stocks are but probably 1/6 of the entire capital markets. We're going to go over, there are about 75 slides. And we'll see. Features of common stock, determining common stock values, efficient markets. See, efficient markets used to be like some sort of an abstract topic. It still is, but by now you know efficient markets is something that Eugene Fama, really did a lot of work on, and he was recognized with a Nobel Prize just in 2013 and preferred stocks. Mark Twain on stocks. I know it's the month of November. It's one of the peculiarly dangerous months to speculate in stocks in. The others are July, January, September, April, November, May, March, June, December, August, and February. And it is. Somehow October has, at times, been an inflection point in the annual returns on stocks. There's usually a lot of action that happens in October. And you can actually, that's a nice little back study you can do. If you can get data for, let's say, 10 years or 30 years or 50 years, you can just calculate the average return on the S&P 500, let's say, for each month, That'd be a nice little study. It's been done, So. Something from Dilbert. I'd be a good stock market expert, buy stocks and then go on TV and recommend them so they go up. What about the fundamentals? Well, it doesn't get more fundamental than that. And this used to be done a lot more. It's still being done, of course, in a disguised manner, but portfolio managers and analysts, they would establish positions in a particular security, usually a thinly traded security with low liquidity, which is basically low trading volume, high bid-ask spread, low market cap. And then there'd be a spike in the interest on that stock because it'd be on some popular TV show. And while people were buying, they'd be dumping. Literally was called dumping, pump and dump scheme. And then the SEC busted a few of those. And so nowadays they have to have a disclaimer that they don't have a position in it. Some common stock terminology. Some of it you can read through. I want to show you, some common stock valuation methods. But just to sort of zip through it a little bit. Authorized stock, outstanding stock, issued stock. It's number of shares held by shareholders. That's where the market value comes from. It's number of outstanding stock times the price of the share. That's market value. This is an interesting slide. Equity versus debt. Some fundamental differences between the two. Do bondholders have voting rights within the corporation? Pretty much no. Stockholders have that. And the right to vote is important. So actually, even if you own 100 shares in Home Depot or Walmart, you are actually an owner so you are actually the principal as opposed to the agent. The managers of that company, unless they own stock, they are basically the agents, which are the employees, They may be a senior employee, but basically they're employees. Who gets payment priority, bondholders or stockholders? Bondholders. In case of company liquidation, they get paid out first. It's usually pennies to a dollar. Typical maturity date for a stock, there's no maturity date. However, bonds have a maturity date. That's why you can use the N button there. And then this is a big one. This is just the law of the land. Are interest payments to bondholders tax deductible? Yes. Are dividend payments to stockholders tax deductible? Now this is from the company, the corporate point of view. So if a company finances itself partly by bonds, then it has to service the bonds by paying by way of bond interest. So that is actually, it deducts from its net tax obligations. It reduces its net tax obligations. But the dividend payments to stockholders, they're not tax deductible. And that has a very important implication. It's called tax shield, which will be there in the next chapter on cost of capital. It lowers a company's cost of capital if it finances part of its capital by issuing bonds as opposed to stocks. But then, as you know, there's no free lunch. If a company has finances with too much bonds, its bankruptcy score goes up, the company is seen as riskier, its cost of capital goes up, the valuation of the company goes down. In fact, there's another Nobel Prize that we won't be actually going through in the class. Modigliani and Miller in the 60s, they did a lot of work on the optimal debt to equity ratio in a company, that how much should a company finance itself with debt, how much by equity. And it's such a major topic, and there is no absolute answer, but Modigliani and Miller, two professors, they gave some indication on that. It's called the Prop 1 and Prop 2, Proposition 1, Proposition 2. So keep your ears open. Maybe in the next class you'll hear about it. Maybe. Classes of common stock. As you know, I'm known for saying this is a deep ocean. By now you guys realize it's a deep ocean. But you guys are actually operating right near the sandy beaches, you know. I'm the lifeguard right there, you know. No problems, nobody's drowning, you know. You know, but it is a really deep ocean. It is a really, really deep ocean, and you can read a lot about it. I mean, this is entirely, corporate finance. You can go and Class A, Class B stock, but basically the difference is between voting rights and dividends. So with Class B stocks, you have more voting rights. With Class A stocks, you have more dividends. Or common stock dividends, they can be paid in cash, stock, or merchandise actually. Sometimes called a stock dividend. You know, you'll have, 100 shares of Macy's, and then Macy's was up, about 10% today at a blockbuster quarter. And then in your brokerage account, you may see 1.5 or 2 more Macy's shares. Where did they come from? So instead of paying cash, they just paid a stock equivalent, So that's a stock dividend. Of course, you can be paid in cash, which basically nowadays is all direct deposits. Or even merchandise, you could get coupons. I actually remember back in Delhi, India, decades back actually, as you know, that my mom would get some coupons from a company called DCM, Delhi Cloth Mills, and it is still one of the largest textile producers in India. And you just get coupons, and you could go and buy, towels, bed sheets, things like that. Just to make her happy, It's like free stuff. How often do firms typically pay dividends? Dividends generally paid quarterly. If you remember, with bonds, we did the semi-annual bond pricing variation. But dividends are generally paid quarterly. Just FYI, guys, because I think you guys are in tune with it. ETFs is where it's happening. If you buy a stock ETF, pretty much most stock ETFs, they will lay a little egg every month, So your dividend will come every month. Why? Because there are about 50, 60 stocks within that envelope, right? And so they just aggregate it all, and for ease of accounting, instead of continuously paying a dividend every day, they just aggregate it and pay it once a month. So reason I'm also mentioning, and I know I mentioned it, is if you short an ETF which has a history of paying high dividends, remember there'll be a continuous bleed on your short position. Just keep that in mind. There are some circumstances when dividends cannot be paid until basically all claims of the government, creditors, and preferred stockholders are satisfied. Preferred stock, we'll talk at the very end of the chapter. It's sort of like a hybrid between a stock and a bond. where the dividend is not guaranteed, unlike a coupon in a bond, but it is promised. And failure to pay a dividend, a preferred dividend, will impact the value of a company, but will not make it technically in default. This is my favorite slide. Sort of have a little joke around that. Some of you from my undergrad class probably have seen it. Valuing common stock is more challenging than valuing bond. Since a common stock has, let me see if I have my calculator. I'll borrow one from someone here. Someone have the TI calculator I can borrow? Carry too much stuff. So valuing common stock is more challenging than valuing bond. Why is that so? Let me see. So to value a bond, you enter something in the N button, the IY, the present value of the bond, the future value of the bond, and payment, which is basically your coupon interest. Stocks don't have a maturity date. So you take your calculator and take this N button here and just yank it out and toss it. No stated liquidation value. Take this FV button right here, straight to Sean. He catches it, he drops it actually. Not a good catcher today. Sleeping? No. So far we got no N button, no FV button. What else? No guaranteed dividends or dividend growth. Goodbye to the payment button. Payment button, take it. Buy, you catch it. Good. Good catch. No guaranteed price appreciation. Sort of like the yield to maturity. IY. Basically what you're left is with PV. And PV changes for those of you who have started looking at stock prices. It changes literally every second. And that's the present value, the current price that is easily observable. So think about how difficult it becomes for investors to invest in a security that some of the basic valuation parameters, they don't even apply. Net of all of this is basically greater volatility. Facebook was trading at $19, then $29, now probably $42, $45. Twitter, we just IPO'd, going up and down. So obviously Twitter's business hasn't changed in the last 4 or 5 days. The number of tweets I've been making has increased, however. So that probably brought its value down somewhat. It's like, all right, this kind of content on Twitter, man, that's bad. Bad for Twitter. Yeah. It's amazing. I love Twitter. I think it's really, that's how it happens actually. It gives me great insights into a lot of things. It's amazing what students actually write. They'll be like, just like you, they'll be sitting here saying nothing. It's like everything, nothing, And then the incisive remarks and comments that they have, it's just beautiful. I just love it, I mean, it's like, man, that knife is sharp, I wish I could retweet it so that the president could see it, Types of stock market transactions. Secondary market. So actually the NYSE, it's called just the NYSE, the New York Stock Exchange, American Stock Exchange, NASDAQ, that's the secondary market. The primary market where corporations raise new capital. All of this is actually a little bit more alive in your mindset. So Twitter was actually, it raised capital initially in the primary market, then it went to the secondary market. Before that, Facebook. And it actually went IPO. Initial price offering. Let's see. what is it, TWTR. So somebody obviously paid right as it was on the day. So far, I'm trying to hover it there. About $49. It's trading at 42 right now. So sometimes IPO is also called initially priced over, you know. And Jay Ritter from University of Florida has done a lot of work 20 years back in IPOs and pricing, and whether there could be a tradable strategy of whether you could apply for an IPO, get it, and flip it. It's called flipping, you know. And what do you think the answer is? It's 50-50, you know. 50% of the IPOs, I mean, I can show you. There's actually a different section, but maybe since I'm here, let's look at this gorilla, this champion, $1,000. You and I use it all the time. I'm using it right now, and most of you don't have it in your portfolios. It actually IPO'd right around here, I know, about $85. And so at least 10 times, if not 12 times up, you know. 12 times up is 1100% return on that. And before that, there was another major IPO of UPS. Now this looks good right now, but those who had bought it for about $66, it hit $50, which is 16, that's 32% down before it went up, you know. So that's when it calls that, that's when it said that, you know, it shakes out the weak hands. Those who didn't really believe in the company, they were just trading it, shook them out. And then, of course, you know, since I'm here, I know there's a section there. Here's the other one that you guys know about. Here's Facebook. And right now it looks like it was up, up and away, but it was really, really a very tough ride for the initial Facebook investors. And also a lot of them were basically Facebook employees, because it IPO'd at about $38. And I remember on a really bad day in August, there it was, less than $19. So that's 50% down. So that's 50% down right there. And there it is. So all these games and all that, you know. And so right here you've seen basically that there is no known strategy about subscribing to an IPO and then flipping it. In fact, I updated my slides right here. I already did it. When is a stock sale and initial IPO, firm goes public, and Google, UPS, Facebook, Twitter. Something called seasoned equity offering, actually. A seasoned equity offering occurs when a company with public stock issues additional shares. So Microsoft, Home Depot, which are seasoned companies, they can actually issue additional stock. So that's not an IPO because they're already in the secondary market. And typically the literature on that, and how do I know this kind of literature, is exactly because my professors did what I've done with you, frankly speaking. You know, during the doctoral program, you know, must have read about 200 papers. And used to remember, you know, at least the intro, the conclusions, and then we had to do a little bit of methodology as well because we were in doctoral students. But I remember from, because my specialization is not corporate finance, it's more investments, is seasoned equity offering basically has a dilutive effect on existing shareholders. So if suppose the current market value is 100 million and it has 100 million shares, so $1 per share, and now suddenly the 100 million becomes 110 million number of shares, you know, it issues 10 more because it says, all right, you know, the company is doing well, let's issue some more shares, you know. But it's like you have this coffee here. I should actually drink some. And you put it in a bigger pan, you know, it's like it's just going to spread thin. And so typically a seasoned equity offering is seen negatively by the marketplace. Existing shareholders are not happy. The ones who get the additional offering, they're happy. Wouldn't you be happy if for some reason, you know, you'd get 50 shares of Google right now, you know, even if there's a slight diminishing in value, but the existing shareholder, it's like sort of like you're in a club. you know, before you're in a club, you want to be inside, but once you're in there, you want to shut that door on other people, you know, because then it reduces the exclusivity of your membership. The different approaches to valuing common stock. The classic one is the dividend growth model, also called DCF, discounted cash flow analysis. Then using multiples, which is what is used in the industry the most. I gave you an idea once, you know, PE, P/E, price to cash flow, and so on and so forth. And there are hundreds actually of methods, you know, free cash flow. So basic stock valuation. One thing I definitely want to mention to you, and I know you already know it actually, because I've said it in 100 different ways. You don't value a company by looking at its price path, because that is truly, it's not my opinion. I give very limited opinion of mine in class. Outside, sure, you can have it, but in class, it's based on literature. Literature clearly establishes a random geometric walk, you know, geometric Brownian motion. So you can't, it was not supposed to go up. This same move here, it would actually have gone down exactly the same way, you know, on the other side. So but the bottom line is you don't value a company by looking at its price path. On top of it, the price path is already visible to hundreds, thousands, or millions of investors. So basic stock valuation is, this is actually very, very simple valuation methodology here. And the concept here is the present value of the future cash flows. That's it. This is an algebraic translation of what I just said. It's a present value of future cash flows. As you know, you will not be asked to memorize it or something like that. In fact, I'm going to show this so that I can establish a formula. So let's say for common stocks, the current price, which is P naught here, if you hold a stock, what do you expect a year from now? A year from now, you expect some dividends, and a year from now, you expect that the price of that will be P1, just that. But we have done the chapter on time value of money, so you can buy the stock today for 100. It could be $90 a year from now, or it could be 110, or it could be at $1 or $10. But that's basically what it will be. That'll be the cash situation there. But because it's a year from now, you have to look at its present value. So if K is the discount rate on the stock, because it's a year, you have to discount D1 by 1 plus Ks to the power 1. And the same thing for P1. Just that. I think all of you are in agreement with that. Nothing major actually. And now I'm going to play sort of a little, you know, algebraic kind of gymnastics with you. So you say, all right, Pang, that's brilliant of you, you know, you're saying current price is a function of next year's price. So now you just told me that, you know, what the current price should be. So now to know the current price, I need to know next year's price. I'm not sure about today's price. You want to have a formula with next year's price. I'm all right, relax. How about we recast P1 as dividend a year from now, which is 2 years from today, and the price 2 years from today. And again, you discounted 1 year back to get P1. You're like, all right, let's see where this is heading. You take this P1 here, these two items here on the right-hand side of the equation, and remember to put it on the numerator here. This is where you need to pay attention. You put it here in the numerator, this 1 plus Ks to the power 1 will become 1 plus Ks to the power 2. The first one will remain the same, to the power 1. And this also, because you're multiplying it, 1 plus Ks to the power 1, so it becomes 2. So now you've made some progress. So the current price of the stock can be stated as a function of next year's dividend and next year's dividend and the price next year. Of course, the discount rate has to be appropriately raised to the exponent to get its present value. Without boring you any further, you can continue to write this P2 as a function of D3 and P3 as a function of D4 and P5. If you keep doing this, we make another significant progress here. We have now successfully removed any occurrence of future prices of the same security from an estimation of its current price. Professor Myron Gordon, I think a Canadian economist in the 60s, a lot of quant work was done in the 60s. He basically formulated this dividend valuation model where the estimated, see this hat means it's an estimation, you know. Because why, you know, P naught is observable. You can actually see what the price is today of Twitter or of IBM. But then you want to see, you know, what the estimated price should be. And naturally you want to see a mismatch between the two. So the estimated price is a function of next period dividends all the way up to infinity. And notice the denominator is rising pretty fast. So what's going to happen is this d infinity divided by 1 plus k, this will be a very small number. And that leads to a nice mathematical property on the next slide. So P naught is the value of common stock today, dt is per share dividend expected in year t, and ks is the required return on the stock. Notice unlike bonds, there's no future value or M term, maturity value. There's nothing here. Now for a constant growth stock, if the growth in dividends is constant, next period dividend is basically a function. So it's like if you put $100 in a savings account at 10% interest, you expect 100 times 1 plus 10%, 1 plus 0.1. And so that's what this is. So the next period dividend is basically this. So D2 can also be written as D naught times 1 plus G squared, and so on and so forth. So now we've made some more progress here. So if G is a constant, so the growth rate in dividends is a constant, then this infinite series here collapses to D naught times 1 plus G divided by RS minus G. And this, coming from here, D naught times 1 plus G is D1. And this is the core Gordon's dividend discount valuation formulation. So the estimated current price of a stock is the expected next period dividend divided by the expected return on the stock minus the growth rate in dividends. Now those three items are easily observable. In fact, frankly speaking, D1 is not observable because it's next year, but because of this link, D naught has already been paid. You can look into your brokerage account. You'll have probably 4 dividends. You add them up, that's your annual dividend, you know, and then you can see the growth rate of the past dividends, and that's the best guess you can make, you know. Now, right here I can throw in major monkey wrenches, you know, right there is why there will be volatility in the estimation here is, as you know, the companies, you know, they keep having these quarterly earnings announcements. If this G is not constant, then this whole thing goes out of whack. If there's market stress, this expected return on stock can go up or go down. And of course, if G again changes, so just 3 simple variables can introduce so much volatility. This can also be recast. So this is the dollar version. You may want to write this is the dollar version. Of course, prices are in dollars. There's also a percentage version of the dividend discount model, which is just this item right here. Let me see if I can do this here. I tried practicing at home. So then you can take this P naught here, bring it here. So it's D1 divided by P naught. And then you're left with RS minus G. Take this minus G, put that here. And so that's where you get. So you have dollar divided by dollar, and G is your growth rate here. And what is remaining is RS. So this is the required return version of the dividend discount model, which is, in a percentage here. You'll see why the market is so volatile. Suppose the next dividend a stock is expected to pay is $1 and the required return is 10%. We also believe that dividends will increase by 5% annually for the foreseeable future. What should the stock sell for today? So this is a simple application of what we just did. Next dividend. See, focus on this. Next dividend. Next dividend. So that's D1. The required return is 10%, that's 0.1. And your growth rate is 5%. You don't have that, like I showed, you don't have any programmed keys in your calculator to calculate the current value of stocks. So you have to actually do it differently right here. Convert the percentage into decimals, so on and so forth. So that's 0.05 here. 0.05 is what? 1 over 20. So 20 goes up, so that's 20 bucks. This stock should basically sell for 20 bucks. You can literally do this as a paragraph. At least for one of your ETFs, you could do that. You don't have to do it. Remember, I don't want repetition. You could just do it for one of your ETFs and say, we bought the ETF at $20, at $22. And if we had done a dividend discount model type analysis, we would have seen back on September 17 that it should have been 20 bucks. So we basically bought an overpriced security. We should have shorted it. Instead, we actually went long in it, and we are actually paying the price for doing that. Something as simple as that you could do. This is why I said just watch why the market is so volatile. And especially stocks are even more volatile than ETFs or indices. What would the value of the stock be if the growth rate were only 3%? So there's a 2% decline, and you would think, 2%. So this 5 becomes 3, right? Everything else is the same. So that's what? That's 0.07. 1 divided by 0.07, 14 sevens are 98, 1 over 14. That's about $14 here. That's 7 over 20. That's a 33% decline approximately in the value of the stock because of a 2% decline in the growth rate. If you go, well, I go here. Go to Yahoo, and by now, probably, how many of you know that probably can also be written as probably? Mr. Doherty is rolling his eyes. He's like, what am I hearing here, Look at that. That's the short way to write probably. Probably. Somebody said not to do that. If somebody says to me not to do something, I will do it. I don't respond well to authority. Why am I here? Probably because I wanted to show you the effect of dividends. What would be a good company? Walmart. Walmart, historical prices. Actually, just do dividends only. Look at that. 0.365, 0.398. You're like, who cares, But it will have a material impact on the price. When that was announced, it had a material impact on the pricing of on the valuation of the company. And because they offer adjusted prices, that's why you're going to use adjusted prices. And that's what, that whole big charts paper and the subsequent, programs and all that I worked on, they're all based on that. You cannot ignore that. In fact, there's something else I'll show you. There's too many tabs open, right? Yeah. A lot of tabs. So notice, so bottom line is a small change in the growth rate of dividends has a very material impact on the valuation of the stock. Basically because literally arithmetically, I can give you an arithmetic reason is it's in the denominator, and it takes away from another number. So if it's a smaller number, this becomes a larger number. If the denominator is larger, the value of the factor is smaller. But the real reason why it is because the current price of a security is the present value of its future cash flow. And so the dividends are future cash flow. In this case, it's just from dividends. Does that mean that we cannot value companies that don't have any growth? No, if that's the case, it's actually much simpler. All the dollar dividends are expected to be the same forever, and the cash flow is a perpetuity. And KS, it's basically KS minus 0. And so it's the same formula, except that it's basically the formulation of a perpetuity. You can work through this on your own. In this case, if the required return is 10% with a $1 dividend, the current price is $10. If the required return is 1%, the current price is $100. So basically, as the required return goes up, the current price goes down. It's an inverse relationship there. And it sort of makes sense, even though it sort of doesn't intuitively make sense, is if the stock's already trading at $100, you don't expect that you're going to have a 10% return on it. You expect the return will be a little smaller on that. This basically, for some of you are wondering that, because in the numerator, you have d naught times 1 plus g to the power t, so, this is going to exponentially increase, and you're right. But we are actually looking at the present value of the dividends, and we are dividing it by 1 plus r, and so they're actually continuously declining. So even though the future values, the nominal values are higher, the current value is actually declining. This is interesting. There will be a homework question on that, and so on and so forth. And for those of you who decide to take any board certification exams or CFP or CFA or anything like that, this kind of trick kind of questions will surface in some form or the other. What happens if the growth rate is greater than RS? The growth rate of dividends. Now notice, you'll have to train yourself to differentiate and distinguish between the growth rate and dividends and the expected return or the required return on the stock, right? Because both of them will be given as percentages. So sort of like think of the yield to maturity versus the coupon rate on a bond, You have to separate those two items. In this case, the dividend discount model requires that RS is greater than G. The required return is greater than the growth rate of dividends. Why? Once again, simple algebra would indicate that if G is greater than RS, you'll have a negative price, which doesn't make any sense. So the constant growth model can be used only if RS is greater than G. On top of it, G is expected to be constant forever because there's only one G, remember? It could be like, so the growth rate, think about how many simplifying assumptions we make, and yet all of this sort of works. But if you think about it from an entirely different dimension, the last two Nobel Prizes in finance, in 2002 and now in 2013, have been to researchers who have done a lot of work in investor sentiment, cognitive dissonance, and behavioral finance. So it is sort of like positive economics has sort of reached some walls there, You can refine the model, you can, add more layers to it, but it simply doesn't explain the volatility of companies. And so naturally, you know, but because we are human beings, somewhat intelligent, you know, we like to have answers to riddles and to puzzles. And so probably investor sentiment actually gives you some insight into the constant fluctuation and oscillations in the valuation of companies. So also anyway, G is expected to be constant forever. Now notice, this is where the trick question can come. G can actually be negative, guys. There's nothing in here that says that growth rate cannot be negative. In fact, a lot of finance companies since 2008 had negative growth rates. And I can show you, you know, the implication of that. Just plot XLF and see how it lost about 80% of its value because they're declining growth rates, growth rate in earnings, and of course the associated growth rate in dividends. G can be negative. You know, if G is negative, you have a negative value here, so you'll actually become positive, so it's fine. So suppose the growth rate is minus 5%, you know. And it had $1 dividends, now it's 95 cents, you know, so that's fine. But this has to hold true. RS has to be greater than G all the time, otherwise you have a negative current valuation. Do you have products around you that have a negative value?
Yeah.
A car?
It's going to depreciate.
The change in value is negative, but its current value is not negative.
If you have a car sitting out back and it doesn't run, and you get rid of it, you might pay the junk dealer to.
See, that's a different kind of car. That's no, I mean there's a subtle difference, but the subtlety is significant. Yep. Huh?
Garbage.
Which is exactly the same thing what Mr. Doherty said. That car is garbage. Nuclear fuel, you know, or garbage. Garbage, you have literally some kind of, it's a tangible product you put in front of your house every week. And a negative price basically means you get the product and you pay dollars with it, you know. If suppose the stock had a negative price, that means you could buy 1,000 shares or get 1,000 shares of Google, and Ameritrade would put, you know, $100,000 in your account as well. That'd be basically a negative price, you know. And so there are items. So basically, you know, for those of you who are economists, you know, it's negative utility. And you have goods and services which have negative utility. There aren't many, they're rare, but basically they are of literally negative utility to us, like garbage, as David said, or nuclear fuel. I mean, when a nuclear plant is built, you know, I mean, that is part of the capital expenditure, is how to remove that heavy water after some time. And also open pit mines and all that. For those of you working, you know, or you know, in timber and all that, you just can't go and mine, then you have to actually backfill it and plant trees and things like that. So, but yeah, in the world of, simple world of stocks, negative stock prices don't make sense. Now you notice how all of this will come together, you know. Dividend discount model is gonna link up with the capital asset pricing model. Assume the beta of the stock under consideration is 1.2, the risk-free rate is 7%, and the risk premium is 5%. Remember, this risk premium is actually simplified. This is actually RM minus RF, right? You know? So that's your risk premium. So what is the required rate of return on the firm's stock? So you can, the simple application of the capital asset pricing model gives you 13%. All right, fair enough? Let's see how we would approach it with the dividend discount model. D naught was $2. That means last dividend paid was $2. And the growth rate is a constant 6%. Find the expected dividends for the next 3 years and their present values. The required return on the stock is 13%. So you see this series of 2, 2, 12, and this will give you that 2 times 1.06 will be 2.12. And then you can check this, 2.12 times 1.06 is going to give you this. That's why we did time value of money chapter before. But these are future dividends, and as I showed in a previous graph, their current value is actually diminishing, even though the nominal value is going up. So you have to now drive the car in reverse. How do you do that? This 2.12, you divide it by 1.13 to the power 1. This one divided by 1.13 . I have a newfound respect for Salman Khan. How many of you know the name Salman Khan? None?
Is he the Khan Academy guy?
I mean, I'm really shocked. I wish the online people could see my face. He's the world's greatest teacher. Got 500 million students so far. Khan Academy. Khan Academy, if you see, you can pretty much type in any topic there, and he has such mastery of the topic. But apart from all that, so I do have respect for that. But his handwriting is so beautiful, and he uses the same set. So I got the same setup. It's on the FAQ written. How does he do that? So I got the same setup as his, but you can see what I'm doing here. But practice is about practice. But no, it's great actually. You guys could probably type in dividend discount model at Khan Academy, and chances are it'll be a better job than this. But of course, you should maybe check it out. Actually, a student told me about it. I didn't know about it. It's supported by the Bill and Melinda Gates Foundation and so many other foundations. I'm sure you guys have heard of Khan Academy. Right, yeah. He was actually a hedge fund analyst. And then he got tired of doing that, based in Boston. And then he started doing this for his niece, teaching her math. And then those videos became viral. And now he has a cracker team in Palo Alto, California, or somewhere around there. I think he has 2 degrees from MIT and maybe 1 from Harvard, I think. He said, what better thing to do than to share the knowledge in the world? So, yeah, that's pretty good, actually. Good stuff. Anyway, guys, so let me see if I can. Yeah, there you go. So here's the present value, did that. And the growth rate is here. And now we have the present value of these dividends. So what is the stock's market value? D0 is 2, RS is 13, G is 6. Plug and play now. D1 we got 2.12. Remember D0 we started as 2. So we got 2.12, no mystery there. You can actually even do 2, and you can do this little 1 plus 0.06 here. RS minus G. And you get $30.29. As you know, there's a story. But that's the basics. Nobody in the streets of Boston or San Francisco or Chicago or LA is going to pay you for what the current price is today. You can look it up. What is the expected market price of the stock 1 year from now? Maybe. Maybe now we're talking. 8 years from now, definitely talking. Well, D1 will have already been paid out. So P1 is the present value of D2, D3, D4, and so on and so forth. So P1 going to be recast using D2, which we also got from the timeline as 2.24, or you can do 1.06 to the power square times D0, and that's $32. All right, fair enough. You could also actually find it, P1 as P0 times 1.06 to the power 1, or 8 years from now is 1.06 to the power 8. And so that leads to this point. If the dividend growth rate is 6%, the next year, the price next year will be higher by 6% as well. So basically, all of the capital appreciation in a stock, in a dividend-paying stock, comes from the growth rate in dividends. Just want to mention that G is not dividend yield, which we'll come to later, but dividend yield is D1 over P0, because think about it, dividend yield. You buy Walmart for $60 today, and then it pays you a dividend of $5 over the next year. So what's that? 1 over 12. 12 eighths are 96, so about 8.5%. 8.5% is your dividend yield there. Let me show you. See this? Dividend yield. Right here, dividend yield. So this is actually 2.38 is the percentage actually. And this 0.47 is the dividend number actually. Look at in this class, now we see market cap, PE, beta, dividend yield. Something is there on the dashboard of Google, There must be a reason. So remember this, that if the dividend growth rate is 6%, the price next year is going to be higher by 6% as well. So current price about $30, next year's price is 32. Where are we going? The expected dividend yield is 2.12 during the first year. It's 2.12 divided by $30. 30.29, that's 7%. And the capital gains yield is the difference in the prices, that's 6%. Difference in the price divided by the original price. Once again, nice time to strike it when it's hot. When you're looking at the graphs of securities on most websites, this is the only growth that they're showing. This part is gone. They're not showing that. Still not sure why not. Total return. Find the total return during the first year. So total return, obviously, if you are a stockholder, is not only do you benefit from the capital gains or the capital loss, but also the dividend that has been paid, like a small little egg there. And so in this case, it's 13%. Remember, we got RS as 13% using the capital asset pricing model. So for a constant growth stock, the capital gains yield is 6%, which is G, which is also the dividend growth rate for a constant growth. That's a simple case here. We've done this. You rearrange the model to rate of return form. So this is the dollar version right here. And a simple algebra, you move this over to the left-hand side. Take P naught here. And this minus G becomes plus G when you move it to the right-hand side. And then the RS, the expected return on the stock, is 2.12. Remember, we started with $2 divided by 30 plus 0.06. And voila, we get 13%. 13% without beta in this case. Of course, sort of like the numbers were sort of orchestrated to arrive there. But if there was a slight divergence, that's okay. Because this is social science. You can have triangulation. You can have different methods of valuation. And you get a ballpark number. Eventually, it's a ballpark number. But in this case, there's exact overlap. In this case, it's equilibrium between the dividend discount model valuation method and the CAPM methodology. Like I said, I haven't shown you the real reason why I'm doing this. You have an idea, actually. What would the current price be if the growth rate is 0? Well, the dividend stream would then be a perpetuity. So $2, $2, $2. 1 plus 0 times 1 plus 0. You can raise 1 plus 0 to as many exponents as you want to. It's not going to change. So your current expected price is going to be payment divided by 13 minus 0. And that's 15%. Literally, the company valuation is going to be cut in half, as the growth rate goes from 6% to 0%. Let's put the two things together, something you're going to see in homework and in other places as well. Stock is currently selling for $40 a share. The stock is $40 a share. The stock is expected to pay a $2 dividend at the end of the year. The stock's dividend is expected to grow at a constant rate of 7% a year forever. The risk-free rate is 6% and the market risk premium is 4%. What is the stock's beta? See, a different way to find beta, you know. Beta you could calculate doing regression between the market returns and the return on the security. If you're given the standard deviation and the correlation, the standard deviation of the stock and the market and the correlation between the stock and the market, you could also get beta is the covariance between x and y divided by the standard deviation of x and y. And here's a third way of finding beta. When you get something like this, what I like to say is start converting, start converting the words into notation and eventually the notation into numbers that go on the buttons of your calculator. So you have $40 a share here. So that's basically your P0. Expected to pay $2 at the end of the year. See, this end is important. So this $2 is not D1, it's not D0, it's D1. There's D1 here. And that's how you literally, you cut through a problem like that and an exam or something, you attack it. It grows at a constant rate of 7% a year. So dividend is expected, so that's G. And see, this will help you map it to your formula sheet in case you have an exam on the topic. And the market risk premium is KM minus KRF, and so that's basically your RP. What is the stock's beta? And you want to find the beta here. So now you know what kind of formulas to look for, and you have KS equals D1 divided by P0 plus G, and you get your expected or required return as 0.12. So use the CAPM to find beta. KS is 0.12, and risk-free rate is 0.06. So do this simple, single equation problem here, and you get beta as 0.15. Beta is 0.15. Look at how many variables you're working with. G, KRF, KM, KS, P0, D1, and D0. This is something I definitely don't do at the undergrad level, and so you should know about it because this is how real world is. If we have supernormal growth of 30% for 3 years, so it's basically called uneven growth rate discounted cash flow analysis. 30% for 3 years and then a long run constant growth of 6%, what is the expected current price? The expected return is still 13%. So you can no longer use the constant growth model. However, growth becomes constant after 3 years. I literally saw this with Microsoft back in 2000 when I was in Boston. Microsoft was like growing every year like 10%, 8%, 15%. And so its stock price was going through the roof. It maxed out at $120.50. And then it split, of course. But I think currently it's about $30. But that's split adjusted. Let's see. It's a great company. It sort of... see here, it's split once, see? So it's 60, it's $120. And from 60, it went to 20, basically. So 1/3 of its valuation. And it's been stable. See, this was the hyper growth stage, And they started writing that now Microsoft is, the market value of Microsoft is equivalent to the 6th largest nation in the world, the GDP of 6. When you start reading those kind of stories, they started doing that with Apple as well, a couple of years back or last year. That is probably a good short indicator. They said, it's the total revenues of Microsoft exceed that of California and things like that, because that growth is not sustainable. It just isn't, because very soon it would be bigger than planet Earth by itself, and as you know, that doesn't happen. But anyway, that's linked here. It has supernormal growth of 30% for 3 years, and then it stabilizes after that. So how do you do that? So it looks obviously a little bit messier, but it's a graduate class, so it's okay. It's not that messy. plus remember, if any of you are actually going to deploy this in the real world, it's all packaged, you know. I mean, you'll have entire companies that are doing this. You can literally buy their software, or your in-house quant group will have some nice automated Excel sheets and things like that. Typically, your work, and then especially as a fundamental analyst, will be to tweak the growth rates. So you'll have some kind of a GUI, graphical user interface, where you change the growth rate from 30% to 34% to 24%, or the market discount rate. And basically, you'll have a spectrum of numbers, projected numbers that then you'll discuss it with your portfolio managers. The value added nowadays is not in crunching. It's in analyzing what has been crunched. Is the analytics, you know. And so that's why you have to be careful depending on what you want to do in your career. You know, if you want to become a core cruncher or something, you know, they throw you in with high T, and then you get a 30% haircut in terms of your wages and all that. So you don't want to do that. Analytics, adding intelligence to data is where the value is. Anyway, guys, so here you get growth rate of 30%. So 2 becomes, you know, 2 times 1.3, that's 2.6 here. And then times 1.3, 3.38. And then 1 year, 2 years, and 3 years, and that becomes 4.394. After this is G is 6%. Notice, no longer 30%. And this is your next period's nominal dividend. So then this has to be discounted 13%, so it's divided by 1.13. This is divided by 1.13 squared, and this as well. And you get your present value of these. However, at this point here, P3 is a function of D4. D4 is 4.6. You can actually apply the Gordon constant dividend discount model here, right? And that gives you $66, but that's again after 3 years. And so you divide it by 1.13 to the power cubed, and you get 46 bucks. And so the current value of this company is $54. So it's called a 2-stage valuation model. The first stage is the supernormal growth, and then the constant growth. So just a little more tedious, but just about it. This is no new information, it's just repetition of old information with a slight twist. What is the expected dividend yield and capital gains at t equals 0, t equals 4? At t equals 0 is 2.6 divided by 54, that's 4.8%. And the capital gains yield is 13 minus 4.8, it's 8.2. No big deal. See, this is interesting. Now you see why there is such a major divergence between total returns on a security versus price returns. Current stock price is 54. The present value of dividends beyond year 3 is $46. P3 discounted back to t equals 0. Here. This $46, guys, is totally the value of dividends after year 3. Elementary algebra will tell me, not algebra, arithmetic actually, that 46 divided by 54 is 85%. 85% of the current value of a stock is coming from its future dividends. And you don't include that in return charts. Amazing, right? That's why you get this. That's why you get this discrepancy. It's from 1996, bonds versus stocks. This is like a boxing match between a featherweight and a heavyweight. No way you can win, right? Except that the scale is spiked. There you go. I mean, you killed this blue one here by incorrectly measuring it. What did you do? You took this one out. And if you think about it, a bond is designed, the growth in a bond comes from its coupons, because its maturity value is fixed. Actually, you don't expect that the price of a bond is going to be the maturity value is $1,000. It's given. The capital gains on a bond is very limited. But the capital gains on bond ETFs is a very, very different matter, because the different maturities are bundled in. So there's a constant, nobody holds the portfolio of bonds within an ETF until its maturity, So its current price is going to change depending on the market discount rate. So I want you to recognize that. See, it's not simple. It is simple, but it's not simple. But I don't want, in the quest for simplicity, I don't want you guys to walk away with a misconception. Here, let me show you this. TLT, one of the most active long-term bonds here. Look at that here. Somebody was very certain at about, what was it, $129. $129. Now it's $103. This is US government long-term treasuries. Nobody wanted to buy it when it was 93. And then everybody wanted to buy it at 129. So there is capital appreciation here and capital loss. So just remember that. Bond ETF is a little bit different from just bonds. Yeah.
Does anything QE have to do anything with that?
I saw the article you sent me. I read all of it. It was, of course, it's.
It was 2001.
Yeah.
2001, right?
Oh yeah, it's QE. Yeah, it's QE. But it's a lot of things. One is price of a bond. Here. Well, let me see if I know that. It's a paper I've been working on for 6 years. Just don't have time, This is what if I may say, I don't like to use this word. This is what I teach in class. Price of a bond is inversely proportional to the interest rate. It's fine. But like Sean here has mentioned, the price of a bond is also a function of policy, which in this case is QE. One of the factors that I'm building in is flight to quality. How do you measure that, I'm proxying it with the return on the market. From 2008, here, right around here, 2008, there was a severe collapse in the market. When there was a severe collapse in the market, doesn't matter what the interest rate is, even if it's going up. Typically, bonds should come down. It's like, that is the safe place. I mean, you typically don't think of jumping out of a window, do you? But we have military officers and police officers here. If the house is on fire, that is a safe exit, You will jump out of the window. So that's the flight to quality. So investors don't think that, okay, interest rates are going up, this is a bad environment, to invest in bonds, because equity is losing value at the rate of 40% a month, and bonds will not lose value that much. So there are multiple reasons, and of course we all like to simplify things, which is fine, But QE too, the government buying bonds, at the rate of 85 billion a month, mortgage-backed securities, wonderful article you sent me today. And then basic economics, demand and supply. There's more demand, the supply of bonds is fixed, so the price goes up. But even here you see the oscillations here. One is either vibrations, I call them vibrations, oscillations, and then long-term cyclical moves. You just can't time it. I mean, this is a time when the market was in great crisis, but the speed at which the bonds accelerated in value, it actually went down when the market was actually in great crisis, later on in 2009. It's not that simple. It comes to simple, it's all P0. P0 is easily observable. That's why I do this chapter on bonds, on stocks, so late in the semester. So if most of a stock's value is due to long-term cash flows, why do so many managers focus on quarterly earnings? This is something you guys have probably heard. I mean, today Macy's stock is up 10% because it had a blockbuster quarter. Sometimes changes in quarterly earnings are a signal of future changes in cash flows. It's all about the future. Like I said, the difference between accounting and finance is accounting is counting what has happened in the past. Finance is discounting what you think will happen in the future. Big difference. Expected price and realized price. Also, sometimes managers have bonuses tied to quarterly earnings. So that's where a lot of earnings management comes in. And management has become sort of a euphemism for, like, putting a little spin around things, and people have gotten into trouble for that. Suppose G growth rate is 0 for T1 to 3 and then growth rate is constant at 6%. What is the current P naught? You can work through this arithmetic here, and the bottom line is you'll see that the current price is 25 bucks, which is literally half of what we had in the previous scenario, And the growth rate basically went from 6% to 0%, and 30% to 0% as well. Actually 30% to 0% and 6% constant. So 3 bad years, and that's what you will see. In fact, I cannot show you a better illustration of this than Mr. Softy, as they say it lovingly on Wall Street, at least at that time. Look at that. What a wealth generator it has been. I remember in 98, 99, they said that the parking lot of Microsoft has only multimillionaires in it. Right from the person who would take care of the facilities to Bill Gates. And I mean, everybody in the Microsoft parking lot was a multimillionaire. Everybody, without fail. They all had stock in Microsoft. And look at that. By the way, one little sort of trivia though, but I want you guys, because soon, we'll be bidding farewell to each other, is don't ever think that Microsoft, I know maybe you can see, maybe you can't. I'm on a Macintosh. I don't know how to sort of zoom it up, but in PC I could. The price is 34 cents right around here. Don't ever, or 26 cents. Microsoft never traded for 26 cents. You guys understand that, right? Microsoft never traded for 26 cents. Why do you see 26 cents there? So you may think, oh, damn, I missed this ride on Microsoft. I could have bought it for 26 cents, or my family or my grandparents could have bought it for me, and then I would have sold it maybe at 40 bucks, or even at 20 bucks would have been great. It was never. You see these S's, these are splits, If you look at the crisp data tapes, you'll actually see that Microsoft, its initial price was $24 and something, So did you want to pay $24 for a company that was basically spearheaded by a couple of punks basically at that time, Paul Allen and Bill Gates, and who was the third guy? Steve Ballmer was later on. He was more the manager guy. He was a football player in there, but he really knew how to get things done. But Paul Allen and Bill Gates, they did the coding. So anyway, guys, it never traded at 26 cents, just so you know. But there you go. I mean, this is the supernormal growth stage, and then this is the constant growth rates. And by this time, everybody knows about Microsoft. The ones who made money are the ones who were just silently, invested in it at the early stages. And the reason I mentioned that, once again, is because you take out three good years here, and that's the implication on the price. If the growth rate is 6% negative, would anyone buy the stock? If so, at what price? Yeah, I mean, the price is not negative. The growth rate is 6% negative. You would buy it at what price? So you apply the same thing here, 13 minus those 6. This denominator actually becomes larger, and the price gets sliced into half from 20 to 10. And folks, this is why I love finance. I can just go back here. Let's go back here. This is one of the most valuable and highly traded ETFs. They say, as goes the finance sector, so goes Wall Street. And you're seeing that. I'm going to post maybe that article that Mr. Sean sent me today, where it basically says the QE2, result of QE2 is somehow the Wall Street found a way to make money for itself, you know. But look at this. This is XLF, the top 60 finance companies in the United States. You know, I mean, Goldman Sachs, Wells Fargo, Morgan Stanley, and then the insurance companies, finance, insurance, real estate. Look at that. This just tanked here from approximately $38 down to, I think it was like $8 or something like that, $6. I even see $6 right there, $6. What happened? These boring slides happened to it. Growth rate of their earnings was negative. So from $50, it goes to $9 right there. Simple. This is a trick that financial advisors are playing on unsuspecting investors now, especially last year. Right there, third line. There's literally been a flood of ETFs which are dividend-oriented ETFs. This bus has left town. The dividend bus has left town. The bond bus has left town. Investors are now looking to invest in securities that have high dividend yields. If you think about what high dividend yield, what's the flip side of it? If your stock value goes down, your dividend yield also goes up, right? Would you like to have a security like that gives you high dividend yield? What about your capital losses, right? It's not that simple, guys. Look at that. So they're like, oh, these finance companies are great. These healthcare companies are great. High dividend yields. Look at that. Dividend yield here is 19%. So you don't want to get into the dividend trap either just because the dividend yield is higher, because dividend yield can be higher for two reasons. The numerator is good or the denominator is small, right? Make sure you do your due diligence on that. But just so in case you want to check it out, SDY, DVY are two new ETFs. So the product managers out there, they're all very smart people. They're informed, you know, they know what the market wants. And so then they ran a couple of screens, some programs, and they ranked the 3,000 stocks listed on the US exchanges into the ones with the highest dividends and then the highest dividend yields, and created an artificial security called SDY or DVY. So you as an investor, you don't have to go and just find your own dividend securities, you know. Actually, we can do a quick check on that if you want to. This is where you can use ETF replay, because this is a charts, because these are ETFs. So let's do the granddaddy of all ETFs. Very simple. SPY versus SDY, and the last 36 months. See, pretty much neck and neck. It depends where your entry point is. Do you see the number somewhere? So volatility, see, volatility of dividend-paying securities is typically lower because dividends are a constant stream. So from 16% to 15%. Total return, see, total return actually on the SPY is higher by 2%, 56% versus 54%. You know, but this is last 36 months. Don't want to use class time for this, but you know, it's called the starting point bias there. Dividend-paying securities actually, you know, there's actually a very different story here. 34% versus 58%. So in this case, actually, it looks like over this period. But, you know, it also depends where you start off and all that. But these are your total returns. between these two. Remember, there's another one thing that you want to keep in mind, is if you have a dividend-paying security, it's a taxable event every time the dividend is paid. So you're paying literally your personal tax rate, which is about 20 to 30. I mean, it depends, if it's long-term, short-term, and all that. So there's some complications there. But you can say about 25, 30% easily on that. So factor that in as well. Where are we? 816. This is an entirely different way and a very simple way of valuation. Applying stock price multiples to estimate stock prices. Analysts often use the PE multiple, which is price per share divided by the earnings per share, or price to cash flow, or price to sales. So many different variables are there. So it's like sort of real estate maybe, It's like I don't think you sell real estate by valuing, what the value of the fixtures is and this. It's like comps, we have real estate gurus in class here. But you can have pretty much the same house in a different neighborhood and it'll have a different value because part of it is the value of the land. And then it's comps, it's like comparative. So you compare it, with what similar house is sold for in the same neighborhood, the same zip code and all that. Because then intangible factors like the quality of the hospital, the quality of the school, how many police officers are patrolling the streets in this particular zip code versus that zip code, all those things they factor in, and so that is not directly reflecting in the value of the fixtures and the wall and the garden that is there with the house. So that's why you have these PE multiples, and I can just show you real quick here. See right here is in Google, you see PE is 9 of XLF. Let's say of Walmart. Keep going to Walmart because I go to Walmart actually. As expected, you can find me at Walmart after 11:30, rushing to finish things by 12. Anything that stays open late is my friend, So PE is 15.4. What does that mean? That investors are willing to pay $15 of 15 current dollars for $1 of Walmart earnings. So now you can compare Walmart to, let's say, my wife's favorite store. She refuses to go to Walmart. I don't know why. It's 16, so it's a slightly more. It has a little oomph to it, maybe. Investors are willing to pay an extra $1 for its earnings, So that's how you compare two similar companies in one way, and PE is the most popular. Even there, I can introduce very simple complexity. What earnings are you looking at? Historical earnings or future earnings? And Google is not doing that. If you go to Yahoo, it actually has forward PE versus TTM, trailing 12 months. Who cares for past earnings? Who cares for past earnings, right? So then you got to get few forward earnings. How do you get forward earnings? There's a lot of variability, a normal distribution associated with the forward earnings, because forward earnings are going to be your estimate or the analyst's estimate, right? So then people say, okay, there was this whole wave back in the 90s. Oh, forget that PE, we're going to do price to sales. So you divide, you see a company, for a company to exist, has to have sales. So you can do total sales of Walmart versus total sales of Best Buy or something like that, and you can get that number. One thing I just want to mention, just like with real estate, you can't compare, got to do apples with apples here. You can't compare the PE of Target with, let's say, this guy here, General Dynamics. General Dynamics doesn't even have a PE. That doesn't make sense. Right? What is it? Lockheed Martin is still a company? Yeah, it is. 14.78 because it's in a different industry. Yahoo will have a very high PE because they're valued differently. See, Yahoo's PE is 29. At one point, it was like 100. Most internet stocks, they had like 100 PE. Now you're going to compare Yahoo with Amazon. Look at that, 1200. But the companies are valued differently. I remember Amazon at $800. $800. The analyst said it'll be $1,000. This was 800 right here. See, I remember that's Boston. I was there, Boston, Cambridge, 98 to 2000. What was it? What's it? 100, literally 100. And then it's split, 8 times. So That was $800 then, by the way. If you think of it unsplit, so 100 is 800. So what is this today? 350? So 400 times 8 is 3,000, about $3,000, you know. That's the value of Amazon. So, but you had to go from 100 down to $8. This game was over. This was like, oh, this is a company that is just basically feeding the shipping carriers, you know. It's making money for FedEx and UPS. And there you go. Jeff Bezos and his genius. Jeff Bezos, a crazy guy. These are people who have changed things. I mean, think about the impact. If you talk about influential people, you know what his latest act of influence is? Like, I can't get my neighbors, you know, to collect their leaves. I have zero influence, you know. You know what Jeff Bezos did last week?
UPS is, or United States Postal Service is now delivering on Sundays in New York and LA.
Bingo, absolutely. They got a government organization and its postal carriers to be driving their vans and doing home delivery of packages on a Sunday. Now, isn't that influence? I mean, how many rules do you have? I mean, how many union workers do you have to talk through and get all that approved, you know? US Postal Service will be delivering not mail, but packages on a Sunday. Jeff Bezos made that happen. $18 billion or $18 billion there in the red, US Postal Service. And this is what I call, I mean, frankly, if I may say, this is American genius here, right here, you know. In one stroke, you know, they got a foot ahead of FedEx and UPS. Because FedEx and UPS do not deliver on a Sunday. They deliver on a Saturday, but not on a Sunday. So, you know, this is influence, guys. This is changing things, you know, changing the... During that time, he came up with this term, disruptive technology. He says, if I don't disrupt the existing, it's no good. Jeff Bezos. His buddy started this company. I think I may have mentioned it, but for those of you who are in the market, I've had students come to me and say, Pank, you saved me $4,000 or $5,000 just by taking your undergrad class. His buddy started this company, so this is just for the guys here. I mean, really, Blue Nile. So Jeff Bezos' buddy had difficulty finding an engagement ring for his fiancée. He said, what a crazy market that is. You just take it to the cleaners. A diamond is basically, it literally is a commodity like an onion or a potato. It's valued with 4 C's. Clarity, cut, color, and one more. They have just the most advanced website, you know. You can get $100,000 ring delivered to your house, FedEx, just like that. I used their service 9 years back. A couple of my students used it. I priced a similar exact same ring at Tiffany's 30% more. Of course, you get the nice blue box, you know, which has great value. But if you're okay with the FedEx brown package, as long as inside there is that laser etched hologram, you know, it has to have the GEM certificate in it. And if you look at it under a microscope, it'll have the laser etch of the number on the edge, the QLED, I think they call it, you know. But you guys should, some of you can check it out. But once again, you know, just the diamond business just changed it. And it is actually, I'm sure you guys are curious to see how that company is doing. NILE, I think. Know that? It's crazy at $100, 110. Stabilized at about $40. What is the market value of this company? Anybody? I don't see it here. I mean, it's too bad. They don't even show the market value, or I can't read it. P is 51. See, so many things, you know. I know I've got slides waiting for me. I know you guys are waiting to take a break. But, you know, market cap, $567 million. This is just a guy, you know, 25-year-old guy, you know, couldn't find a ring for his fiancée. That's called value creation. You got to acknowledge that. So anyway, this is how I came. I give you, in a way, I can read this, you can read it, but I'm giving you literally making it happen, making it real, if I may say, this same entity multiples, all of this is easy stuff, EV to EBITDA, EV to customers, how do you value a company? For the internet, it used to be measuring by eyeballs, how many eyeballs are hitting a page. If you want to see some great valuation work, there's an NYU professor who valued Amazon stock back in '99. He has just an unbelievable, million people following him. He's written some of the greatest books on valuation. See here, I just do ASW there and it's right up there. You see that? That's how big he is. NYU professor, he has just the greatest. And everything is free. His Excel spreadsheets to value Twitter, to value, this is just tremendous value. So you guys can check it out. Ashwin Damodaran is a very down-to-earth guy. He's professor of finance at the Stern School of Business, NYU, where he teaches corporate finance and equity valuation. And he's got a lot of books, but you just go to his website, Just go to the website, you can download all those spreadsheets, you can just punch in all those things. He values things that existing models have no answer for. I remember his claim to fame was valuing Amazon, and he said it is valued reasonably fairly. And of course, he came in for a lot of criticism. But that's okay. Maybe I'll stop with this Dilbert slide here, stock market expert. Everybody should buy stock in that company, sell your house if necessary. Should be worried that the PE is 900, your track record is terrible, and you only recommend stocks you own. Well, Ron, as you can see from the 1 week chart, the stock only goes up. It's sort of a okay Dilbert, it's fine. Guys, let's take a little break here. Thank you. So this is a continuation of the chapter on stocks, which is basically chapter 7 from the Brigham Card book. And in the last section, we talked about using market multiple methods. Well, as you know, it's not simple. Nothing is simple. It should not be that simple. We try to make it simple, which is a good thing, actually. Yes and no is a simple answer, but it's hard to find that answer nowadays. Is some of the problems, and you can refer to Sheffrin chapter 2, which is there in the case book also, is it becomes a problem of comparing, apples, oranges. While you have a nice number, a PE of 30 for Yahoo, or 50 for Yahoo, and 14 for Walmart, is suppose for an industry the average PE is 20, but the range could be from 10 to 50. How do you know whether your firm should be compared to the low average or high performers? Then industry relative PEs. Then PEs are calculated on an industry relative basis. So within let's say the defense industry, then you can see which one is high, which one is low, and that makes more sense. So the slicing and dicing just continues, and that's what makes finance interesting. Size relative. Then there's another very big risk factor is size. You can't compare the PE of large companies with that of small companies, even in the same industry. So then you have to normalize it with the size per million of market cap. And then style relative. So style is whether it's a growth company or a value company. A value company pays dividends. A growth company does not pay dividends. Google does not pay dividends. The investors say to Google, please don't pay dividends. You have aggregated a group of people who we sort of accept are maybe smarter than us. And what you are doing is collectively going to add more value than how I would do things. So you keep the money and put it back in your company. I can go back to Microsoft and show you that when Microsoft started paying dividends, that's when it crashed in its market valuation, because it turned from a growth company to a value company. You see this? These little D's here, there are none of these D's before. Microsoft was not paying dividends. And Windows 95, then XP came, and then it's like, how many more versions of Windows do we need? And their declaration and first issuance of dividends, but the market knew that they are thinking of dividends way before, so this is also about factoring in information. So when the first dividend was issued, actually, around 2003, the market had already factored in that Microsoft is sort of acknowledging and declaring to the world that they have run out of ideas. They did not believe in the internet. I actually remember hearing a Microsoft executive saying that video is not supposed to be delivered over the wire. It just requires too much bandwidth, and we don't have that. We will never have that. And now you can get high definition on a basic router. So that's how it is. I don't forecast three things. I don't forecast technology. I don't forecast the stock markets. I don't forecast life. Everything else you can have some sort of an idea. The imprint is there. The signals are there. What's going to happen? This is a great slide. You can abstract from all the talk and all of the hoopla around a company in the marketplace by just looking at these two basic valuation methods that we have covered in this and the previous chapters. Here's the dividend discount valuation approach towards estimating the current price of a stock, and here is the capital asset pricing model, the security market line, estimating the required return on the security. Factors affecting stock prices. This is like something that you can maybe print it out and you can keep it with you, or maybe have it around on your wall if you're in this business. Look at this here. What happens if the dividend growth rate is expected to increase? So you're following a company, and now you hear that the dividend growth rate is increasing its dividends. But the growth rate is expected to increase. If G is increasing, the numerator goes up, and this denominator actually goes down because you have a bigger negative value coming out of the denominator. Price shoots up. If the firm cuts its dividends, as happened to XLF, the companies within XLF, the firm cuts its dividends, this number goes down. This number goes down, and this number goes down, and this is a smaller number. This whole thing is in upside down whack there. Price goes down. A dividend-paying company, if it cuts its dividends, it is literally said it is slaughtered in the marketplace. It really is slaughtered in the marketplace. It typically happens to utility companies, healthcare companies, and finance companies are the three sectors that pay the highest dividends. They're all value companies. It's better not to pay a dividend than have a dividend and cut it, because that is a distress signal to the marketplace. What about the market risk of stock increases? Basically, the beta increases. So here the transmission mechanism is slightly longer. Beta increases, this number is going to increase. Eventually, KS is going to increase. That is, the required return on the stock is going to increase. KS is increasing, your denominator increases, the required price goes down. If you think about it, if it's a high risk security, the current price has to be lower so that the expected return is going to be higher. Overall perception of market risk increases. Same thing, KM minus KRF, the market risk premium goes up, 2008. KS goes up, again the price of a stock goes down. Inflation expectations increase. That goes through the KRF part here. It's a little bit more complicated there. KRF goes up, and depending on the interaction effect, eventually the current price of the security will come down. And so these are, how you can see that these are the basic core factors how stock prices get affected and the transmission mechanism. Why are stock prices volatile? If you think about it, this is just a three-factor model here. And you can have so many more. You can have sales in there, free cash flow there, debt ratios, and so many other things. Is inflation expectations, risk aversion, company risk, G, anything could change, and so your current price will change. Here's a simple table. You can work through this. Nothing new here. So suppose you got three growth rates, 4%, 5%, 6%. and expected return on the stock 9, 10, and 11%. As you see, as the expected return goes up for a given growth rate, controlling for this, remember the timeliness safety paper, you control for safety, let's say. So as the expected return goes up, the current price comes down. For a given expected return, as the growth rate goes up, the current price goes up. And this example here illustrates this price of 40. Now there are just two variables here, they're changing. You have a valuation change from $28 to $66. What is market equilibrium? In equilibrium, stock prices are stable. There is no general tendency to people to buy versus sell. Expected price must equal the actual price. And thus, expected returns must equal required returns. So this is required returns here through the CAPM, and this is the expected returns through the dividend discount model. The two should be equal. If they're not, that means there is a mispricing and a trading opportunity. Arbitrage and semi-strong market efficiency will restore equilibrium, and there will be no profits after transaction costs and taxes. Now, you in your final papers are including transaction costs and taxes, which is how it is actually in the real world. How is equilibrium established? I'll probably post a short video that a math student who I'm linked with, he sent me. He's also a financial econ student. It's a 30-minute video on HFT, high frequency trading, which is sort of really big nowadays. There they show, some of the disequilibrium situations and how arbitrage is happening. So it can get very complex. But here's a simple arbitrage situation, let's say. So the expected return is greater than the required return. So if this is greater, one of the things for this RS to be greater is that this is a small number, P naught. The denominator is small. P naught is too low. So if price is lower than the fundamental value, then basically the stock is a bargain. So buy orders will exceed the sell orders, and price will be bid up. And if price is going to be bid up, then RS eventually is going to come down, and D1 by P falls until the two are going to be in equilibrium. And here is the sort of the next part of this chapter here, which is the efficient market hypotheses. So this is it started off with the random walk hypothesis, which was most likely a term coined by another Nobel laureate, one of the greatest economists of the modern times, Paul F. Samuelson, who got his doctorate at the young age of 20 back in the 1920s. And his book Fundamentals is a book that the doctoral student has difficulty going past the first 10 pages. But he was a professor at MIT until probably 4 or 5 years back, but is no longer there. But anyway, he came up with the random walk hypothesis, which is the theory that stock price movements are unpredictable, and thus there's little way of knowing where future prices are headed. The movement of stock prices from day to day do not reflect any pattern. Statistically speaking, the movement of stock prices is random. However, it's skewed positive over the long term, which means it sort of moves up over the long term. I think even Isaac Newton said something like, I can estimate the motions of heavenly bodies, but not the spirits that govern the markets. The efficient market hypothesis, which, as you know, Eugene Fama got a Nobel Prize for just a couple of months back, is basically asks the question, do security prices reflect information? And can be modified to do they reflect all information, and even further, do they reflect all new information? Why do we want to look at market efficiency? At least two major reasons. Well, we can look at the second one first, which is that implications for investment. So if you think that there's an inefficiency in the pricing, inefficiency that reflects in a mispricing of a security, then obviously, basically you are saying that I can find an overpriced security or an underpriced security. If it's overpriced, you short it and make money. If it's underpriced, you buy it and you make money. But there are bigger reasons to study market efficiency, and one of them is allocation of scarce capital. And that has been, in a way, the difference between the capitalist system and the communist or the socialist system. And most of the communist regimes are no longer there. Which regimes still exist that are actually communist still? At least two of them that come to mind, right? Cuba and North Korea. Yeah, China. I mean, do you think you think China is communist? We have a student from China. It is. Is it a communist country? It is? Really? Okay. Yeah, I mean, yeah, of course, officially it is, yeah. But like where the market forces are replaced by policy, you can actually continue to produce goods that are not required by the social economic system. And so that is a misallocation of scarce capital. You're still producing, certain kinds of railway carriages or certain kinds of radios or spindles and things that you don't really need. But in the US especially, you don't have companies that are producing, certain types of radios or Discmans or things of that sort. Even though I read the other day that there's a company in, I think, in Kansas that produces, I think, 20,000 videotapes a day, blank videotapes. So there's still and cassette tapes. There's still a market for that, This is a slide that I think I put together. It's my favorite slide. Let's see if I can. Oops, that's not. Oh boy, what did I do? Why are price changes random? I was supposed to go through it bullet point by bullet point, but it's not happening right now. So here's a simple thought experiment. Why are price changes random? Now you have to agree or disagree with me. Do you accept that prices react to information? And we're talking about real new information. We're talking about like the typhoon that hits Philippines, or real information, not the editorial in the newspaper, which is an analysis of news, but rather real news. News probably is an acronym of North, East, West, and South, so something that's coming from all these directions. So if you really get to the core of it, the only reason prices change is because they react to new information. Now, do you agree that flow of information is random? Like real new information, be it a new alliance that Apple is going to have with Samsung, or Walmart is going to have with Amazon, or something like that, or some other geopolitical event. So flow of information is random. Therefore, price changes are random. End of story, period. With that, I'll stop this chapter.